Well, good morning, everybody, and thank you for joining us for another edition of the Market Commentator podcast. Today is Wednesday, July 15th, 2020, and my name is Andy Wilms. I am the president and CEO of the Milwaukee Company. And joining me this morning is Mike Wilms, who is now the Milwaukee Company's Chief Operating and Compliance Officer. Mike joined our firm as a full-time employee this week, and I'm very excited about that, having Mike on our team. So welcome aboard, Mike.
Thank you very much. Good to be here.
Thank you. And it's just a quick reminder that nothing in this podcast should be construed as investment advice. So let's begin with a little recap of the market, as we usually do, since our last discussion. The Dow, NASDAQ, and S&P all finished last week higher, with the NASDAQ leading the way with a over 4% rise. And that places the NASDAQ about 20% above its year-to-date, 20% return year-to-date, riding a wave of investor enthusiasm for the mega cap tech stocks such as Amazon, Netflix, Microsoft, and Google. But automaker Tesla alone gained $100 billion in market value in just the last 2 weeks. So there's been quite a surge into the mega cap arena. This week, the market opened higher on Monday and then pulled back because there was an announcement that California was closing indoor businesses such as bars and restaurants. And that news took the NASDAQ from up 2% at its high to close at down 2%. Yesterday, it was the Dow that was the big winner, rising by over 500 points, or just over 2%, as investors started to look outside of the tech arena and started investing in some more cyclical names in the market. The S&P and the NASDAQ also rose, but by a much smaller degree. They were up about a little over 1% for the S&P, and the NASDAQ was up nearly 1%. So all those fun things being said, Matt couldn't join us this morning, so maybe you could bring us up to date on what's going on with the COVID-19 situation.
Well, I think everybody is aware, based on media coverage, that there's been an increase in the number of cases through the increased level of testing. California, Florida, Texas, on a consolidated basis, the three states had over 30,000 new cases on Monday. Yesterday, Tuesday, there was over 67,000 new cases found through testing. And I think it's important to understand how the testing level has increased across the nation. If you go back to April, the entire country was testing, let me just make sure here with my notes, 165,000 tests per day for the time period July 1st to July 12th. They tested 665,000 new people. So the testing level has ramped up, and that's kind of what the White House is speaking to when they talk about increased testing levels. And essentially, we're now testing people based on a desire to have a test done without demonstrating symptoms. Mm-hmm. So it's not like initially to get a test you had to have shortness of breath. You needed to have some demonstrated temperature, fever, and a health issue that warranted a test. Another important consideration, 67,000 new cases. That's a very concerning number. But we need to understand also that a large number of the new positive results, the patients are asymptomatic.
Yeah. One of the things I noticed is that there's been yesterday was somewhat disturbing, was not only the increase in number of cases, but the new surge in deaths, where the number of deaths jumped yesterday to over 900. suggesting that there may be in the early stages of a new upward bias in this number. But I also know there's some very positive news. Both this are on the development of of a virus by a couple of companies. A German company I know has announced its development of a vaccine, and Moderna yesterday too. You want to bring us up to speed on that a little bit?
Sure. I mean, the German company is BioNTech, and they're working in conjunction with Pfizer, and they're moving up their anticipated approval dates based on resources allocated to the vaccine development. Moderna received approval for a 30,000 patient expanded trial based on the results from the smaller initial phase 1 test on 45 patients. The test is around a vaccine. All 45 of the initial patients developed the antibody responses that was hoped for with the design of the vaccine. And there were some side effects demonstrated, fatigue, shortness of breath, but nothing of a material nature, and hence the FDA has approved the expanded trial of 30,000 patients. Now it's important to understand that the expectation is the potential for approval of the Moderna vaccine by the end of the year, but the trial itself won't conclude until the end of 2022.
Okay, but I know, for example, BioNTech and Pfizer, I believe they said they could have several hundred million doses ready by the end of the year. So they're going ahead with the manufacturing of the treatment of the medication, even though it hasn't passed testing, with the notion that if it does pass, they'll be ready to go.
Yes.
And if it doesn't, then that'll be a wasted effort, but that's just part of being prepared.
And that I think is key to understand. The White House and the Trump administration are funding both the Moderna trial and the Pfizer BioNTech trial and one other. So the funding is there to produce the vaccine in anticipation of approval. And
that I think is a very positive thing. So
exactly.
Let's just hope that these vaccines pan out as hoped. Let's jump into the round table discussion. The first question I thought I'd ask, it relates to a topic I know is near and dear to your heart, which is corporate earnings. And this week's yesterday really marked the beginning of the release of corporate earnings. Some are expecting it to be the worst corporate earnings seen in 12 years, with expected earnings to fall by, I think, a neighborhood of 44% or thereabouts. And we've had very few companies give guidance because of all the COVID-19 implications on their earnings. So I would think there's going to be a considerable amount of surprises. Do you want to give us an idea of what you're expecting with regard to these earnings reports this quarter, and any insight maybe?
What we've seen to this point with the overall market performance is the big tech stocks that you had mentioned earlier have had some pretty impressive year-to-date returns. Large cap tech, I mean, the 5 big names in the S&P 500 are up like 20% on the year. A lot of that is driven by the fact that their service offerings and the technology that they provide are directly benefited by the changes in the economy in response to the virus. So the expectation is for the technology components of the S&P 500 to be up almost 6% earnings-wise in the second quarter. On the flip side, you're looking at the financials. You're looking for up to a 57% decline in their quarter-over-quarter earnings, and that the financials are normally the first industry to report, and we saw large loan loss reserve increases by the three large banks that reported on Monday and yesterday to the tune of $28 billion. So they're to your point, nobody's willing to issue guidance because everything's so uncertain. It's going to be a volatile, up and down, all over the place kind of earnings season.
Yeah, I think one thing's for sure, the outlook for second quarter's earnings has been very bad, and perhaps the worst in maybe 10 years or more for most of the members of the S&P. As you said, there's a handful of stellar performers, and we'll talk a little bit about how long they can continue to perform as they have, at least on a price ratio. But overall, it seems to me companies are increasing their leverage, and while revenue profitability decline, which means you're looking at higher interest costs but lower interest coverage, because there's less cash coming in from operations. And I think, I kind of think the second quarter is going to be one of those kitchen sink type quarters, where companies throwing all the bad news, all the trash, everything they were afraid to talk about in the past, because they figured all will be forgiven because of the extenuating circumstances brought in by the COVID-19. So that might make things a little worse than expected too. And I think the outlook for the third quarter is a little more bleak than maybe people are expecting, but probably not as bleak as the second quarter. I expect earnings will kind of bounce off the bottom, but maybe not as dramatically as some on Wall Street or some investors are expecting.
And I would agree with that. I mean, with the reinstitution of some of the social distancing rules in California, the reluctance for, if there's a resurgence in cases, the reluctance for people to travel and get involved with going to restaurants and theater and things of that sort, that'll all bleed into third and fourth quarter earnings.
Which leads me, your answer leads me nicely into what the second topic I thought we could discuss this morning, and that is whether there should be further stimulus. There's considerable support for another round of stimulus. Secretary Mnuchin has gone on saying the Trump administration is preparing to work with the Senate to pass a new bill, and a lot of that's going to be directed towards a continuation of the Paycheck Protection Program and other type of government stimulus. Second round of economic impact payments to households, enhanced unemployment benefits. All these things are being tossed around now, and I was just wondering, what do you think about all this? Do you think the government is wise to continue with a no holds barred, approach to this? China's taken a much more measured approach. They've kept a lot of their powder dry, and are probably in better position as a result to deal with further complications down the road, should that arise. So are you still all in, or do you think maybe the government needs to be a little more cautious in here?
Well, I think that Mnuchin's comments around a much more thoughtful and scaled back paycheck protection program is warranted. The thought process is to not necessarily extend the federal unemployment benefit of $600 a week, but to redesign that unemployment benefit as a incentive to return to work. It's really unclear what might come out of either the House or the Senate, and what the administration is thinking at this point. Still a very fluid, moving target.
I agree, and it's surprising to me, how the stock markets have kind of largely ignored these coronavirus infection rates in some respects, but businesses of all sizes are feeling the brunt of this virus and face a more uncertain future. When you combine that with the fact that it's an election year, I think, the additional stimulus is pretty certain. But what concerns me, as I've said in prior podcasts, is the long-term impact of all these resulting massive government deficits. There's a number of bad things that could come from this, including the possibility that, well, almost a certainty at this point, that taxes will be raised, which tends to have a bad impact on the economy long term. The dollar value of the dollar could seriously be impacted, falling, and we risk the risk of growing inflation as a result of all these massive deficits. So I do agree that we have to be very careful, but I think we have to keep both sides of the equation in mind and not just focus on the immediate concerns.
Well, and I agree. I mean, there is keeping both sides in focus. There's a balance, and hopefully the decisions that are made in Washington are going to be more reflective of balance versus extremes.
Let's certainly hope so. Previous discussion, we talked about the fact how these 5 mega cap tech stocks are really way outperforming. As you might say, kicking ass and taking names. I think that's what you were fond of saying back in your rugby playing days. But the
It's still applicable.
Well, be that as it may, we've seen the NASDAQ, as you point out, jump over 22%, is over 22% above its 200-day moving average. We saw Tesla alone gain $100 billion in market cap value in a couple of weeks. So it seems like FOMO, the fear of missing out, is really taking hold of the market right now. And my question is, do you have an opinion as to how long this can go on? How long can these mega tech stocks continue to soar?
Well, and it goes back to my earlier comment about some of the big tech stocks, and particularly the big 5 that you're mentioning, being in the sweet spot relative to the economy and their business models being focused in areas that benefit from responses to the virus. I mean, the scary part, looking at Amazon, which I think is the largest market cap right now, their physical fixed assets are now within billions of the total fixed assets for Walmart. So you couldn't justify Amazon's valuation without Amazon Web Services and their cloud computing subsidiary. But the expectations for the Wall Street analysts are the earnings for these 5 companies and technology in general are set up to continue to grow even through the virus.
Well, I think that's all well and good, but if you take the big 5 out of the S&P, as you were pointing out, I mean, there's large swaths of the market that have just dramatically underperformed and haven't seen any recovery, and there's only so much money that people can invest, in these 5, in these 5 mega cap companies, or even the top 10. Some investors seem to think that, the new age of giants has come upon us and it's going to continue for decades, but that's very inconsistent with historical data. Generally speaking, the top 10 most valuable companies in the stock market have tended to underperform in the long term. And the reason is pretty obvious, right? As prices go up, it becomes increasingly difficult for companies to generate sufficient corporate earnings to justify the price rise. Now, there are some that think, hey, listen, the world has changed, and you shouldn't be looking at what happened in the past to evaluate these companies because this is a new era. But you and I both know that it's often said that the 4 most dangerous words in investing is that this time is different.
Correct.
And that's what people are once again saying about these 5 companies, that they can continue to rise to price earning ratios that have been hard pressed to see. Now, they haven't reached the point they did in 1999, 2000, but we're getting closer every day. And I guess, my bottom line is, only time will tell you who's right. If these high prices, stock prices of these companies can continue to rise and they make the earnings to justify the price increase. But all I do know is that as the price goes up, risk goes up. And so, we really, whether you want to continue to overweight these mega tech names really depends on your tolerance for risk and your investment objectives.
No question. And as you know, with active managers, they're going to set a price target for individual stocks. And as these stocks have rallied to the levels that they have, there has been some trimming of the positions based on those set price targets. There's been a lot in the press about who's been lightening up on Microsoft, who's been lightening up on Amazon. And, at some point, people are going to recognize that elevated level of risk that you're speaking to and start rotating into other sectors in the market.
And I saw
reverting to the mean.
Yeah, or yeah, that would be a good outcome, or they'll get out of the market altogether. A lot of these, a lot of the money that's going into these tech companies is coming from newer investors. Robinhood came out with some amazing statistic about how many of their new investors are investing in these names. Whether those investors will, just head for the hills and pull their money out of the market and go home, or whether they'll rotate into something else is going to be an interesting issue to develop or development to watch.
It'll be an interesting end game.
Yeah, exactly. Well said. That's what. Then so if we're worried about people maybe not rotating out of stocks, the next question becomes, where will they go? And that really raises the question about whether the role bonds should continue to play in a portfolio, which is being brought in question because right now government bond, especially on government bonds, but bond yields in general are really, really low. I mean, the 10-year Treasury yield has been bouncing between 60 and 70 basis points, or 0.6 and 0.7%.
Correct.
And you wouldn't expect that to even keep up with inflation.
Well, it doesn't.
Go ahead.
It doesn't. I mean, if inflation is 1.5 or 1.6%,
exactly,
you've got a negative real return on a Treasury.
Right. So, given that, do you think what role would you suggest that bonds play in a portfolio? I mean, do you just kind of suck that up and keep your commitment to bonds because of the diversification benefit they provide? You can't. I don't think the academic research is there to support a diversified portfolio and the risk mitigation aspects of a diversified portfolio. So yes, you're going to need to maintain a fixed income exposure, but it's the type of fixed income and where on the maturity time frame you're investing, and it's all around risk mitigation given the current price environment. Well, I think that's right. I think you're going to have to be careful on what you buy and consideration to give whether or not you should be buying individual bonds versus bond ETFs. Both fluctuate, of course, with changes in market value. So if interest rates go up, the bond prices will drop, and that'll be reflected both in the value of individual bonds and the value of bond ETFs. But most bond ETFs, you can't hold to maturity and get your money back, right? You don't have that guarantee. There's no maturity date. Now, there are a select set of defined maturity date bond ETFs that do, for the large part, give you much more certainty in terms of what you'll get at maturity. But with bond ETFs, it's much more natural to watch the prices fluctuate, and investors get nervous, right? They see the prices if interest rates do rise, there's going to be a tendency to want to exit bond ETFs much more quickly, I think, than individual bonds. And I think you might want to start looking at some alternatives to corporate bonds. One option might be not corporate bonds, to bonds in general, and one might be a CD ladder. CD rates are very, very low too, but you don't have that as much fluctuation with the market price of a CD.
And I believe CDs are limited to a 5-year maximum on maturity.
Yep.
So
you're keeping your duration, your interest rate sensitivity short. Your duration.
Worst case is that you do receive your principal back at the end of 5 years if you were as far out on the investment horizon as possible.
Right, subject to whatever inflation has done to the value of your money, right? Inflation could.
Exactly.
So if you want to continue in the ETF space, you might look at more of these ultra short bond funds. That's obviously going to be less sensitive to this. If you look at inflation-linked treasuries, and that might be a way I think investors could look at hedging the risk against rising interest rates. You might even consider some stable, high dividend-paying stocks. Companies like utilities that don't tend to fluctuate a whole lot in price. They're not as stable as bonds, but you will probably get a significantly higher yield on that. REITs, another possible real estate investment trusts, you could consider that. And you can be a little careful in that arena, because as you and I have talked about at different times, some of these REITs that are invested in commercial real estate. What's that?
Retail malls and hotels.
Yep.
They're struggling right now relative to migration to online shopping and the virus. Exactly.
So you got to be careful if you're going to play in the REIT space, but there are some opportunities, I think, there. And then an interesting one I saw an article about in the Wall Street Journal, I think it appeared yesterday, was the potential attractiveness of Chinese bonds, Chinese government bonds, which are yielding, close to 4%, according to the article. And, China has had all kinds of issues in the past with inflation and other reasons that Chinese bonds were more risky than your traditional, obviously U.S. government bond. But when you have this much difference in yield and some of the changes that have occurred in China, it's probably something that might make some sense for some investors to take a look at. So anyway, all right, well, I guess, Mike, that pretty much uses up most of our time this morning. I would like to offer you the opportunity to close up if there's anything that you wanted to bring up that we haven't had a chance yet to talk about.
No, I think, we pretty much covered the high point for this last week, and it'll be interesting to see what the next couple of days are going to highlight with decisions in Washington around additional stimulus, and what kind of response we have to the virus.
It most certainly will be interesting, and I think this will be a very important next few weeks. So we all better buckle our seatbelts or strap on our helmets, as the case may be, because I think we might be into for something here that I think we'll get a little more clarity, I would say, in the next few weeks ahead. But one thing we may not get any clarity on is the political arena, which would normally be driving the market at, in a presidential year. You would see some major, and that really hasn't been, from what I can see, there hasn't been much consideration of that by investors. So that's a whole nother can of worms that has yet to be opened in terms of what it'll mean for the markets.
Well, I think that it just creates an additional level of uncertainty, and what we're trying to do is understand the situation and eliminate as much uncertainty as we can. And there's just no clarity on the political front, on the virus front. So a lot of question marks. You and I will be talking on a weekly basis for a long time.
Yeah, there'll be plenty for us to discuss, and we'll be happy to talk to any of you individually if you have any concerns you'd like to share with us. That should wrap it up today. I'll thank you all for joining, and please keep in mind that the views expressed in this podcast represent Mike and my personal opinions and not necessarily those of the Milwaukee Company. Also, it is recommended that you don't act on any of the advice you've heard in this podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. So on that note, I will say goodbye, Mike. Goodbye to all our viewers. I hope you all have a great day, and we'll be talking to you again next week.
Thanks, Andy.
You're welcome. Bye now.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.